Hi there everybody, it's Dale Beaumont here from Business Blueprint and welcome to our latest Business Blueprint webinar. So our special guest presenter tonight, his name is Ed Chan. All right, Ed, over to you.
G'day Dale, g'day listeners, welcome. Tonight will be mainly for small businesses. Let's get on with it. This information I'm talking to you about is of a general nature. You need to get some personal advice to see whether it's applicable to you. The tax rates for individuals range from, and I'll just quickly share this with you, from 0 to 18,200 there's zero tax. From 18,200 to 37,000 there's 21% tax. That includes a 2% levy. And from 37,000 to 87,000 it's 34.5%, including the levy. From 87,000 to 180,000 it's 39%, and above 180,000 it's 47%. And as you can see, the company tax rate is 27.5%. So from a sensible tax planning point of view, and this is all legitimate, legal and everything, you can pay yourself sufficiently to keep you under those thresholds. So you can keep yourself at around 34% up to 87,000, and between husband and wife that's double that, that's 160 odd thousand, and the rest, if you left it in the company, then you only pay tax at 27.5%. Now the rules changed recently and they reduced the tax rate for businesses, companies that run businesses, from 30% down to 27.5%. But if your company is an investment company, just invest in shares in the stock market or it buys a property and it's purely investment orientated, then the tax rate's still 30%. But for businesses, it's down to 27.5%.
So Ed, what should we do if we start, say we're paying ourselves the 80 something and our husband or wife's, our partner's, another 80, it's 160,000 we're drawing out as income. We're paying a lot of personal expenses with that. This money that stays in the company, obviously we pay our tax on it, then it stays in the company. What do we do? And what about if that money just keeps kind of like piling up, so to speak? What a good problem to have. Then we want to kind of, can we either keep investing in our business, but when we start making profit, do we then take it out and then have to pay an additional sort of tax once it comes out of the business? Or should we be trying to invest it back into, say, buying a commercial property and leave it in the company and start building up assets within the company?
Absolutely, great question, Dale. I'll answer it in two ways. The first one is it allows you to manage your tax liabilities, because even though you might pay 27.5% tax in a company, that tax, unlike the tax you pay in your own name, is gone, but the tax you pay in a company isn't gone. It sits there in the franking account. So it sits there as a credit. So somewhere down the track when you retire and your tax rate is less than 27.5%, you can take that money out as a dividend and pay no tax on it, as long as your personal tax rate is the same as the company tax rate. If it's more than the company tax rate, you pay what's called a top-up tax, up to the rate of tax that you pay personally. If your tax rate is less than 27.5%, you actually get a refund back. So it's a fantastic vehicle to have for tax planning, because then it allows you to determine what level of tax you want to pay. Unlike your personal tax rate, when once you've paid it, it's gone. There's no credit, there's no franking credit, there's nothing. It's actually gone, completely gone away. Tax in a company, it's a good place to pay. That's the first thing. The second thing is, as you accumulate more and more money in the company, it's a really good idea to invest it. You can invest it through the company if your company isn't litigious in the things that they do, or you can set up various entities where the company can, for example, you can buy your own premises and then pay a rent from the company to, say, a super fund that may own the premises. And I'm going to touch on that in another slide down the track. So you can invest the money from the company, and you've just got to make sure that there's asset protection structures in place, because if the company got sued, then those assets that it invests in can potentially get lost in a litigation. So we'd have to look at what it is that you want to invest in and how best to do it. But absolutely, the company can do that. And as long as the income comes back to the company, it's only taxed at 27.5%.